Hi, and welcome to the live quarterly market update from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown, Cody Demmel, and Sean Roth. Good morning. How's everyone doing?
Good morning. Good, how are
Good
you?
morning.
Good. So we love doing these events once a quarter. It gives us a chance to put what's recently happened in perspective, think about the long term from an investing and planning perspective. Katie, talk about why this has been, we've been doing this for 4 years. It's a really important part of what we're doing as communicators and advisors.
Yeah, it's an opportunity for us to bring our community together. And so much of what we do, so much of what we talk about with the families we serve it's rooted in education. So an opportunity to help build some of that education, to help build some of the perspective of what's happening around us. So we're thrilled to have you here today, and we're excited to get going.
Yeah, and Katie and I are going to start off talking a little. Well, first of all, the good news is there's nothing happening in the world right now, so it's a really quiet time to be thinking about, planning and investing in just a benign environment. No, we're Katie. It's well, first of all, just the structure. We're going to talk a little bit about putting this moment in fall of 2024 in perspective. Then we're going to talk some about what's happened in the markets, and if you stick around to the end, we're going to do a demonstration of how we model different scenarios for our clients. So for those of you who've been working with us for some time, you're going to recognize this as the way we design scenarios. But if you're new to our community, it's a really helpful way to say, all right, how does this all become actionable in the form of a financial plan? So Katie, let's start with the elephant in the room. It's election season, and there's a lot of ways to be thinking about just some of the drama that impacts the markets and volatility and everything else. How do we tend to think about election season when it comes to being, financial advice?
Well, you know what? It's interesting because there's a lot happening around us. There's a lot of news flow, constant news flow. But I think something that we have come to fully understand and appreciate is that the anxiety around this time is nonpartisan. It,
Yeah.
it doesn't matter. Yep. Exactly what your political beliefs are. There's a lot of anxiety that's kind of rallied up. And what we like to do is help put that in perspective a little bit and help people recognize what might impact them versus what are some things that maybe we can sort of, safely ignore.
Yeah, because a lot of the anxiety, it's totally fine to feel anxious about what's happening in the markets, the potential economic implications, the elections, everything else. But when it turns into action, that can be a challenge. One of our charts that we wanted to share today, this one, I think we've used this one before. This is going back to 1896. So it was a couple of years before Katie and I were born that we started tracking this data. But what it shows is if you only invested during Democratic administrations, if you only invested during Republican administrations, and if you were fully invested, and the fully invested here is you just have to stick with it. You have to stick because if you get too caught up in going one way or the other, you've really missed out on a ton. And it's a hard lesson to feel in the moment, but it's absolutely proven true over the last 100+ years.
I think something else that we've learned we know to be true also is that we can't pinpoint a specific date and say, all right, things are going to change on this date, or I need to be prepared for this date. There's always an evolution of a lot of different factors that play into that. And it's rare that one particular date will make or break your investment plan, your financial plan.
Yeah, I mean, many times we'll be in conversations with clients and say, I'll wait until after the election to blank. I'll wait until my retirement date to blank. I'll wait until New Year's to the specific date thing. It's a process. It's an ongoing conversation. And I think as we look at the last 2 months of 2024, the most valuable thing you can be doing is thinking about the impactful decisions that you can make in 2025. It's a great time for reflection. There was a story in the Wall Street Journal just the other day about this October theory, that October is the time that you should be thinking about the really kind of meaningful planning work that you can be doing to make process changes in your life, be it financial, physical, relational, whatever it might be. And I think that's an important perspective to have this time of year.
Yeah, I like that you talk about process. And one of the things that the article highlights too is setting up those routines so that if you do want to make changes, you're in a position of strength where you've started to lay the groundwork or the foundation. You it's hard to think about dieting, for instance, to say, all right, I'm going to cut out all sugars, or I'm going to cut out all fats, and I'm going to lose X number of pounds. You have to work your way there. You have to create a process, I think, for a healthy eating, healthy living that enables you to be successful to reach that goal. But it's all about the routine and the process. It's never the end date.
Yes. And we heard a line recently that said information used to be really valuable. Like it used to be hard there were only so many books in the world. There were only so many, the pre-internet information was very valuable. Now we are inundated with information. Over the next couple of weeks, you're going to be, overwhelmed with tons of information about what's happening. What is really scarce is our attention. And I would challenge, all of us to think about where we focus our attention over the next couple of months. And the better use of it, both financially, personally, everything else, is to focus on the things that we can control and really identifying what are the meaningful things that we can be doing financially to set ourselves up for success, and also diverting attention away from the things that are going to be kind of the transactional distractions of the day. And there's going to be a lot of them here in the next couple of weeks.
Yeah. So once again, one of our goals for today is to help build a little bit of perspective of what's happening around us. But as Dennis said, we're going to take a couple of minutes to look at some of the types of planning work that we do for clients that allows us to be aware of our surroundings, but focus our attention where we should be focusing our attention, for families to be focusing on things that are important to them. So just to lay the land here a little bit. Oh, and one thing, we did forget to mention is please feel free to use the chat function. You should see that down in the bottom right-hand corner. If you have questions along the way, please feel free to use that. We're happy to try to answer those as we go.
Yep, absolutely. So now we're going to bring back in Cody Demmel and Sean Roth. They're going to help us to walk through some of the quarter that was. This has been a really strong year for a lot of markets. If you flash back 15 months ago or so, we were talking about what typically happens after the Federal Reserve pauses raising interest rates. It's usually a pretty positive experience for the markets. So Cody and Sean are going to help us to walk through that a little bit and talk through what's been our experience here in the third quarter of 2024. So guys, I'll pull it up. Sean, why don't you take it away?
Yeah. So, as always, we like to take a really balanced approach to all the news that we hear, and especially that you're going to hear over the, next couple of weeks that Dennis had mentioned. So some of the, glass half full things on positive, inflation fell to 2.6% in August, providing that the Fed, they're going to decrease the Fed funds rate. Recession indicators are not flashing red, sort of like they used to be. And parts of the yield curve have uninverted, meaning that, you're getting compensated for, purchasing longer bonds and term risk and those types of things. On the other end, the glass half empty, while the Fed's concerns have shifted from inflation, to the labor market, with unemployment rose slightly to 4.2% this summer. Geopolitics and the upcoming election have some investors nervous, and I think there's some case for headline risk there. And the other thing is, if China will follow through on the stimulus package, and will that be enough, to boost the consumer confidence and bolster their property market, which has taken a hit over the last couple of months.
Hey, do you know what I just thought about? It's the 2-year anniversary since the Bloomberg headline about 100% chance of recession.
Oh my goodness.
Remember that? It was fun.
Yes.
It was like October, November of 2022, where there was like Bloomberg study, 100% chance of recession in the next 12 months. Here we are. So it just a lot of factors at play.
So speaking on that, one of the charts that we wanted to bring up was going over some of the potential indicators people use to potentially look to see if a recession is coming. I'm not going to go into the details of all 4 charts just because it'll take up too much time. But what I just want to point your attention to is if you look at where we're at on all 4 charts, we are very close to the long-term average. So there's not any, as Sean said in the last slide, there's not any flashing red indicators that we're going into a recession. Right now, obviously, as Sean said, unemployment has gone from 3.5 up to 4.2, but still a 4.2 unemployment rate is still well below what the long-term average is inside of the US. So obviously, we're going to continue watching these as going forward. But as of now, there's not any flashing red signs that a recession is coming.
For most of my career, 5% was considered full employment.
Yep.
That 5% was the bogey, and we've been under that for some time. So yeah, it's the numbers are kind of settling in a nice place.
I think one other thing to point out is what we talked about on a lot of the other market updates was what kind of landing was the Fed going to have? Was it going to be a hard landing, a soft landing? As of now, it looks like it is going to be a soft landing, and hopefully they can keep inflation under control without putting us into a recession. So we've seen, as Sean just said on the last slide, we've seen inflation, come down from 5 to 6% down to 2.6. And obviously the expectation hopefully is that's going to continue happening going forward. So what we're going to talk about on the next slide is after the Fed starts cutting interest rates, what potentially happens to the stock market over the next year to 2 years. So looking at this chart, what we see is obviously this black line right here is going over when they make their first cut, which was last month in September, and the expectations they're going to cut again in November. So looking at the last 6 times they did that, 4 of the times we had very strong returns, 2 of the times we had a sell-off in the stock market. But if we think back to these 2 times, they were completely different times than where we're at right now. 2007, obviously going into the great financial crisis. 2001 had the dot-com bust, where every other scenario was more along the lines they were cutting rates because they were they raised rates because they were trying to fight inflation, but then they started cutting because inflation came down and they just wanted to spur the economy going forward. So we have seen a slowdown in some parts of the economy, but that's exactly what the Fed's hope was, without putting us into a recession to fight inflation.
Just a quick comment on the idea of a soft landing. And the soft landing means like green lights, things are okay. Like we've settled into more normalcy than the kind of the ebbs and flows that we had for so many years starting in 2020. Oftentimes in conversations with investors, we'll get the question, can't we just get out of the market and wait till things are okay?
Yeah.
And you know what? If you're saying a soft landing is things are okay now, you've missed a lot in the last couple of years from a return perspective.
Yeah.
And you have to be careful of, like, by the time everything's good or presumably good, or that you hit that soft landing point, a lot of other things have happened. The markets anticipate that. So you kind of have to weather, some of the volatility in the interest of making returns. And we're going to see that as we talk about just what stock and bond markets have done over the last couple of years.
Yeah. So, now to talk about, everyone's favorite subject, bonds and the fixed income market. So this chart shows that, bond returns were positive across the board for the second quarter here. And all that with treasury rates falling, across the entire yield curve in varied amounts. Just as an example, the 1 month, fell just over, 50 basis points, the 1 year, about 111 basis points, and the 10-year treasury fell, again, just over 50 basis points. So we've seen those rates fall kind of across the board. What this chart also shows is that corporate bonds have, certainly fared better than treasuries, and non-U.S. bonds, have continued to be a positive contributor, earning just under 10%, in the last 12 months. So it's good to see a nice, well-rounded bond market, with returns across the board, which we haven't seen in some time. The other thing this chart, makes you want to think about is, while CDs and cash investments have certainly provided a nice return for the last couple of years, they've really underperformed bonds. And with the Fed, possibly continuing to cut rates, anything that you have earmarked for over 6 months to a year in savings, you really want to make sure that you're getting the most out of those investments, and especially as you see those cash, interest rates go down.
I think another important point to look at here is if we think back to the last 12 months, so this is looking at the end of September, the Fed only cut 1 time over the last 12 months, and you've had almost double-digit returns in all the different fixed income environments. So again, kind of going back to what Dennis said, waiting for the all clear, you potentially missed out on double-digit returns from fixed income.
Yeah, and there's a lot of folks have a lot of money parked on the sideline, I think, waiting for that could be missing out. So this chart shows a 10-year look back at the entire fixed income market. That gray area, it shows the 10-year range of yield to worst over the various different sectors. That purple line that we see in the middle, that's the median return, and that blue diamond is the current yield where we're at today. So this shows that with recent Fed rate cuts, we're still getting attractive rates currently. And one thing we like to tell our clients is the best indicator of expected returns of the bond, is that yield. That's been proven. So you see that we're well above the median in just about every category across the board. It's been a really strong 12 months for the fixed income market, and we have a strong outlook moving forward. One of the best things is in your portfolio is to find the right balance for you between stocks and bonds. And that's actually what Cody's going to go over next is, the equities market.
The one thing before we move on from this slide, there was a term that was used for the better part of the last decade, which was called the TINA trade, as in there is no alternative. You had to invest in stocks because if you look at that, U.S. Treasury on the far left-hand side, that average return of less than 2% on Treasury bonds, going back over the last 10 years, that just wasn't sustainable. It wasn't enough to earn income for retirement portfolio. In many cases, you couldn't lean on it for retirement income. Suddenly, with these numbers ratcheted up, the bond portfolio is pulling more weight in a retirement plan. And that's a really good thing. You don't have to be over concentrated in stocks to get your returns. You can get above the rate of inflation from high quality bonds, which is a positive development for anyone with a retirement plan.
Yep, good point.
Yeah, Sean, I love that you mentioned this is a good time to really check in on the risk of your portfolio and make sure that that's aligned with where you should be, where you want to be. Because as Dennis said, there are a lot of places across the portfolio now where we can start to get some quality returns. I shouldn't say start to get, we have been getting them over the past year or so, but just to check in, once again, the level of risk throughout the portfolio is a really great exercise.
Yep, good point. Especially since we're going to go over top stock returns here now, since we've had such a good market over the last year, and honestly, going back to the fall of 2022. So going back to when Dennis was talking about that article that we're 100% going into a recession, we've had a very strong market over the last 2 years. So, and one of the things we want to bring up, so looking at the last 12 months, so going back to last September, US large cap is up over 35%. International large cap up 25%, US small cap 26, international small cap 23, emerging markets 26. So it's been a very good market, not only inside the US, but also internationally. One thing that has happened a little bit recently is outperformance from some of the international or the markets that aren't, reported on as often. So if we just look at the third quarter, again, nobody's going to complain about a 6% return in a quarter. But US was underperforming some of the other areas. That is something we're potentially looking at going forward, just because some of the valuations are getting a little stretched inside the US. Not saying that there's going to be a large sell-off or anything. Obviously, volatility is completely normal, but we do want to make sure and bring it back to the expectations that you're working with your advisor. These 35% inner returns are not, normal for the long term inside of the stock market. The average is around 10% annually. So just want to make sure we bring that up. Obviously, we hope the bull market continues, but just as we were saying, there is, different aspects you can get returned where you don't have to take the risks that stocks have.
Hey, Cody, there's a question in the chat, a good question on, are higher returns in fixed income likely to continue as rates are reduced further? And this is, it's good because it helps to understand how bonds work. So just simplistically, when rates go down, bond prices go up. So if you own a 5% bond and the Federal Reserve lowers interest rates, that 5% bond becomes more valuable because you can't get it anymore. So when we look at, again, this last 12 months of returns in the fixed income markets, 5% of that is coming from the income that they're paying you. The rest is coming from price appreciation as that rate becomes more scarce across the globe. So I think to the point earlier, the best expectation for future returns in fixed income is the yield from the date that you purchase it. But then you can also expect that if rates come down or continue to come down, you should see some price appreciation as those, which is one of the reasons why we talk about, be mindful of cash, CDs, money markets, and know that there's some price appreciation that can happen if rates were to come down.
Yep, good point.
Let's go to our favorite chart. This is the one we love.
So we normally bring up the Callan chart. The Callan chart that we normally bring up in the past is a little different than the one we're bringing up here. So the one we brought up this year, and just to do something a little different, is looking at the monthly returns for 2024. So as we just saw over the last slide, year to date, large cap equity is up the most, up around 21, 22% year to date. If you look at the best performers month over month, large cap only had the best return once. If we look at some of the other areas that have more volatility, whether it be emerging market or small cap, you can see, so for an example, emerging market in April was the best performer. In May, it was the worst. It was still positive, but the worst. Then June, it was the best, then the worst. So knowing, obviously working with your advisor to handle this volatility is really important. And then if we look at the US small cap, for an example, in April, it was down 7%. In May, it bounced back 5%. So this goes back to holding the investments for the long term. If there's any rebalancing you need to do inside your portfolio, that's why it's important to work with your advisor. So they're obviously watching the market and making sure you're going back to your target allocation to take advantage of either very strong bull markets that we've had the last couple of years, or potentially when we have a sell-off if there's any rebalancing. The one other small chart on the right side is just looking at the US sectors and where the returns came from in Q3. So where the returns have been very strong over the last 2 years is in technology. And Q3 technology was only up 1.6%. Some of the other areas that didn't get the love over the last couple of years, but the valuations are potentially a lot better than inside some of the tech stocks, were up over double digits in Q3. So this also goes back, not only do you want to have diversification in international small cap emerging markets, you want to have that diversification inside the US large cap too.
And Cody, I think what's fascinating about this chart is that it's only the third quarter. So utilities being up 19% in a quarter, you're exactly right. You don't want to carve out sectors or particular areas and say that's not where the growth is, because you don't know when that growth is going to show up.
Exactly.
Yep. Katie, we've talked about this before. It's just sometimes when we assess performance, we're thinking of the portfolio like moving like this, like very monolithic and just it's all kind of moving up and down. When actually it's more like, think of stacks of money. There's a stack that you have in large US stocks, a stack you have in bonds, a stack in international. And each one of these stacks at different times is higher than the other. And when we talk about rebalancing or drawing retirement income, you're not pulling from this one thing that's moving up and down all the time. There's different things at different times. And that's why the discipline of rebalancing, asset allocation is so important for anybody who's kind of being purposeful in retirement planning.
Dennis, as you're talking, I'm like envisioning like a piano, like somebody playing, like
Yeah,
somebody on symphony where all the different keys are playing at different times, and
I should have had a guitar analogy. That would have been more appropriate. Like I can't play the piano. It's not. It's a dormant skill set. So. All right, let's talk about international. What's happening around the world?
All right, so this again is looking back at Q3. So the dark blue line that you see here is looking at the global returns on average based on all the returns from all the different countries around the world, just looking at the Q3 numbers. US is actually to the right, so a little lower returns from almost every single other country. So again, going back to what we said in some of the previous slides, this is a reason why you want to have that diversification, and kind of what Katie was just saying. You never know when, 1 month it's going to vastly outperform, inside what's the US stock market. Like China, for an example, again, as Sean said in the beginning slide, they announced that huge stimulus package, and that obviously had a huge bump on their, economy. The stock market was up over 20% in Q3. But this is why, you want to have that diversification, not only inside the US, but a lot of the other countries.
Yeah, I mean, look at that far left end. That's all emerging markets. It's Thailand, Philippines, Singapore, Malaysia. That's, you could have made the case of why would I own these things a year ago, but the snapback is real.
I think another reason potentially. Oh, sorry. Go ahead.
No, that's okay. I do feel like a conversation that has percolated probably with all of us at different times and speaking with different people was, you know, okay, I'll invest in emerging markets, but I want emerging markets ex China, or I want to carve out this country or that country. And
Yeah.
once again, that shows the risk of doing that.
Yeah. Yeah, you definitely have to talk with your clients about the pros and cons of each and make sure, you're both on the same page of, what you're going to invest in.
Exactly.
Yep. So this is a really interesting slide. So on average, over the last just about 100 years, 94% of years, the stock market, the S&P, has had a drawdown of 5% or more. And almost 2/3 of the time, it's had a drawdown of 10% or more. So it's really interesting because this year alone, we've seen 3 separate scenarios where the market has dropped 5%. One in April, one in August, and then again in September. And 75% of the time, the market has finished positive, and it's had those drawbacks. So it shows us that volatility is very common, and it's actually healthy in a stock market. And you can see, 26% of the time, we'll get almost 1/4 of the time, you'll get a 20% or worse decline in the market. So it shows us that, we really have to have that long-term vision. It's natural, it's very common, and it's actually very healthy in the stock market.
Yeah. And, we talked about kind of what's happening at the tail end of the year. This is prediction season. We're getting to the time when everyone starts to put out their predictions for their very erroneous predictions for 2025. Does anyone remember what the predictions were for this year? Volatility.
Single-digit returns.
It was going to be like a volatile year, an election year. This has been, ironically, a very smooth, like a couple of 5% pullbacks. We haven't had a 10% pullback this year. We had a couple of them last year, nothing this year. And it's been a very high return, low volatility year, which was not on people's bingo card this time last year.
They also were potentially.
On the flip side, sorry, Tony.
Yeah, go ahead.
On the flip side of that, though, too, this is still a good reminder to make sure that you do have emergency reserves set, that you do understand kind of those shorter or intermediate term goals, and that you're planning for those appropriately as well. But the long-term money, allow it to be long-term money.
Yep. Very, very good point. Because stuff happens. That's what this slide says. Stuff happens. Yeah. Inevitably.
Right.
All right.
But the reminders, just as we were saying, it's financial planning is a process, and really being clear and really kind of putting your thought into your goals and when they show up, and how comfortable you are taking different levels of risk along the way to reach those goals, and working with your advisor to map that out. As Dennis mentioned, we're going to toggle over here in just a minute to see kind of what that looks like for some of the clients and the families that we work with. But then also just good investing behavior along the way. So the money that is invested, making sure that you are focused on keeping the internal costs down, being mindful of taxes and what those moves make from a tax standpoint, and also where there are opportunities from a tax standpoint. So when we get those times of volatility, let's make sure we're doing some tax loss harvesting. Let's look at, as your income fluctuates over time, let's look at opportunities like Roth conversions, other things that are going to help set the stage for success for you and your family going forward.
Excellent. Excellent. All right. So we're going to jump over quick. We're going to show you, please feel free to ask any more questions you might have on the markets. But Katie, one of the most powerful tools that we have in working with clients is eMoney, which is our financial planning platform, where we get to do dynamic financial planning. It's one thing to turn over a ream of paper and say, here's your plan. It's another thing to say, what if you make choice A versus B, and how does that impact you in the long term? Or better yet, if the goal isn't to maximize your assets at the end of retirement, how can you live a meaningful life supported by your financial resources in the good years? So we're going to pull up our financial planning platform, eMoney. Katie, you want to talk through kind of, for this client, Frank and Joanna Miller, just how we think about the dynamic planning and just the holistic approach to financial planning?
Sure. So once again, this is Frank and Joanna Miller. This is a sample client here that we have in our system. And ultimately, when we think about planning, we want to help families build an awareness of where they're at, have a full understanding of their foundation. So everything from their assets, the things that they own, to liabilities, things that they owe, the debts that they have to pay. We want to have a solid understanding of the money that's coming into the household. So whether that's Social Security, pension, dollars coming in, or employment dollars, and then also understand what the dependency on the portfolio assets will be and how that portfolio needs to generate income to help support their expenses. So to know the income side of it, the expense side of the equation, and then help to plan for different things that they may not be thinking of. So we can stress test. Once we have that foundation, we can project it out, and then we can start to stress test those numbers and see, okay, what if there is volatility in the market? What if you decide to work a couple of years later or retire a couple of years earlier? So what Dennis is pulling up here is the decision center. And it's called that because it helps families make decisions, well-informed decisions about their financial life. And so what we're looking at here for Frank and Joanna is kind of the graph of their lifetime portfolio value. And once again, that takes into account all the money's coming in, all the money's going out. It also takes into account growth on the portfolio and making sure that's aligned with the risk in your actual portfolio. It factors in things like inflation into the numbers as well. So we're looking at the different moving factors and then spreading that out. And this is their base plan. But what we can do is we can toggle on and off different decisions that could be made. So once again, if they decided to change their retirement date, for instance, we can overlay and see, okay, if they wanted to work an extra day or an extra year or two, what that looks like, how that could positively impact the plan. Now, on the flip side, they might decide to retire earlier and the numbers may go down, but the basis and the support is still there and their probability of success may still be strong. So they may make those lifestyle decisions to say, I want to enjoy a couple more years of retirement. So Dennis,
I think
yeah.
Even just looking at this model, the way we would talk to Frank and Joanna is to say, by retiring a couple of years later, the difference is about 10%. It's a $586,000 increase, all things being equal, on a $5 million portfolio. Is it worth it to you? Is having 10% more invested worth it to you to work a couple of extra years in your 60s? And it starts getting to the qualitative conversations. And you might say, listen, I don't need that extra bit. We're going to be fine. And now we get to think about the really constructive things, the more important things, frankly. And same thing with Social Security. Usually, all things being equal, put up this toggle here, changing Social Security decisions might mean a little bit less in the short term, but you're making value-based decisions on is that meaningful to us? Do we want to, take it a little bit sooner or later? It's a very personal decision, but what this does is it helps us to identify, which personal decisions are most meaningful for this family, considering everything else. And Katie, I'm going to pull up the cash flow report because I think this is just a great view of where it all comes from, which is one of the most important questions that investors have. How do I meet my expenses? You want to talk through what this colorful chart looks like?
Sure. So as you're floating over it, you can see each of those colors represents a different cash flow area. So in those first few years before retirement, the primary area of income coming in is from employment income. And then we can see where Social Security, that basis down at the bottom, that dark color there. So we can see where Social Security starts to come in to, once again, create a foundation. But then on top of that, we have withdrawals. So we know what we need to pull from the portfolio to fill that gap. Eventually, in the orange, that large orange area in this particular family, they have significant retirement assets. So that orange section represents their required minimum distributions. So for Frank and Joanna, they can see between Social Security, a little bit of other income. So that could be rental income, it could be pension income, but mostly between Social Security and the required minimum distributions, they're covering just about all the household expenses throughout retirement. So when you think in terms of, and sometimes we'll invest, sort of via buckets and say, okay, what is the purpose of this investment over here? What is the purpose of this investment account over here? Because they're going to have different contributions over time, and it's important to be aware of that and how they play into the picture.
Yeah, and underneath all of this are the numbers. So we can see the details that underpin this. So one of the most frequent questions we hear in financial planning is, yes, but have you thought about taxes? Yes, but have you thought, we do think about the whole picture and where it all comes from. And speaking of taxes, Katie, go ahead.
No, I was just going to go there. Go ahead.
All right, let's talk taxes.
Yes. So we can see during those earning years, taxes are pretty significant, and then they fall off a cliff. Because if you don't have outside income streams coming in, or maybe you do, but maybe they're not taxed at a higher rate. If you only have Social Security for a couple of years, for instance, you may not be taxed on that. Or only be half of it might be taxed. So it's going to be a lower. So you could have this lull in taxes. Well, to us, that's like bright flashing lights of planning opportunities. So that's something where we may say, okay, that's a great time for Roth conversions. But also understanding how Roth conversions show up for the family, for maybe the couple that we're speaking with, but also from a legacy standpoint. We're always looking at things kind of to the extent that families want to plan beyond and to think through, how does this money show up for me, for the next generation, for the next and the next generation, kind of through that whole continuum. But these are things, once again, from a planning perspective that we keep on the radar, that we want to be aware of.
And one last thing we wanted to share with you is one of our favorite new developments from the last couple of years. Katie, you want to talk about the one-page financial plan?
Sure. And this is where we spend a lot of our time with families, just that overview of, okay, what does the portfolio value potentially look like over time? In this particular vision here, we're looking at it with the application of historical market returns, kind of giving us a little bit of that variety, because we know not every year is going to be up. We're going to have some ups and downs over time. But this is kind of a one-page sort of snapshot of how things are progressing over time, where the cash flow is coming from. It gives a quick snapshot of your balance sheet. And we run Monte Carlo, some probability analysis also. Once again, applying historical market returns to 1,000 different trials to try to get a better understanding of how the portfolio can migrate over time, building in all the market volatility, or a variety of market volatility. And then, once again, bringing it down to like a probability of success number. So we know, all right, are we in the green? Are we in the orange? Do we need to make some adjustments going forward? Or is this a pretty solid plan for now? Something to mention too is there are a lot of numbers that show up, and the numbers over time can seem a little crazy at times, both to the positive and the negative, depending on how the plan is coming together. But more often than not, we're paying attention to the trends. We want to understand the trends so that if we see something way out in the future, we say, maybe we need to make a tweak. We can make a small tweak in the near term to make sure that you're still on track for the long term. And so those, just to kind of put that context out there.
Very good. Very good. So that's the crux of a lot of what we're doing right now. So this stage of where we are and where we're investing in our team and in our technology is to really pull forward the simplicity and clarity that we feel our clients need from a financial perspective. There's a lot of noise, there's a lot of chatter this time of year, but if we can pull it forward to say, if you knew you were going to be fine in the long term, what would you do differently today? And let's have that conversation about how to plan for the year to come. So we appreciate everyone being here today. Feel free to reach out if you have any follow-up questions. But I just want to publicly thank our team for putting all of this together. They do a ton of work in the background, researching and paying attention to what's happening in the markets, but also listening to what we hear clients say all the time. So Cody, Sean, everyone on our team has done a great job of just kind of being attentive observers of what's happening in the markets so that we can come and deliver our communication to you. If you know someone who needs an experience like this, needs some of that confidence, we're happy to have the conversation. Our team stands ready and willing to work. So thanks for being part of our community, and we look forward to talking with you soon.
Thank you so much.
See ya.
Bye.